value of using a professional financial planner is in the personal relationship that develops between client and planner. This relationship allows for a true understanding of the client's needs, aspirations, and goals. Planner understands that one size does not fit all. The risk budget of a client cannot be adequately assessed through a simple risk profiling questionnaire, as it does not talk to the holistic nature of a client's financial affairs. Financial planning truly is the small tweaks that one makes to your financial position over time that really adds value. The most important investment decision you can make is asset allocation based on your personal risk budget. It is important for yourself and clients to realize that asset allocation is much more important to long-term returns than underlying specific assets. Why? This is because different asset classes deliver vastly different long-term returns. As indicated in a recent study by BlackRock, which looked at US asset class returns over 20 years to the end of 2016, and showed that US cash delivered an annualized 2.3%, bonds 5.4%, and equities, that is in the S&P 500, delivered 7.7% per annum. Understandable, the high risk came with high volatility, but over the short term, returns aren't as dependable in your more risky asset classes. Passive funds have gained huge popularity in recent past due to outperformance of all but a few professional money managers. And robo-advisors have aggressively used this to support the superiority of their low-cost offering. Why pay financial advisors and professional portfolio managers if you can earn the same return at a lower fee? Few investors realize that most of the returns from passive funds and therefore robo-advisors comes from an individual share, that being Naspers. If you look at the stats of returns over the last 2.5 years, Naspers returned 7% per annum, while the rest of the market, excluding Naspers, delivered only 3% per annum. And this is even highlighted to a greater extent over the last 6 months, with Naspers delivering 4%, while the rest of the market, excluding Naspers, delivered negative 1%. Using recent data provided by Morningstar, over the last 3 years, almost half the flows into index funds have been into the Satrix Swix Aussie 40 fund. This makes sense as it is a logical building block in your multi-asset passive funds that are sold by your robo-advisors. But what few investors realize is that this return has been largely driven by a single share, that being Naspers. If you look at data over the last 2.5 years, Naspers delivered a return of 7%, while the rest of the market, excluding Naspers, delivered only 3%. And the last 6 months to end June 2017, Naspers delivered 4%, while the rest of the market, excluding Naspers, delivered only negative 1%. And this is shown in the red and the black blocks on the diagram, respectively. The weighting of Naspers in your Satrix Aussie 40 is almost 22%. So it is obvious how important the performance of the share is in the performance of the index over time. The diagram does show the weighting at 15%. This is because it's talking to the broader Aussie 40 index. Irrespective of index weighting, it makes absolutely no sense to invest 20%, just over 20% of your investable capital in a single investment. That is, of course, unless you have your superior crystal ball, which a bet like that implies extraordinary confidence in a single investment opportunity. So you wouldn't let a portfolio manager take a bet like this, but some 8.5 billion rand of clients' funds have been invested in the Satrix Aussie 40 Swix over the last 3 years. The performance of this decision has been good, but is this due to luck or design? Active managers often do deserve to be criticized, but they are good managers that stick to their conviction, construct good quality portfolios that achieve a superior risk-reward characteristic, and that don't charge exorbitant fees. And this might be worth paying for. A good financial planner can help you choose such managers and construct a superior portfolio that will help you achieve your long-term financial goals. This also might be worth paying for.